Winning without genius investing for the rest of us. Investing doesn't have to be complicated or reserved for the financial elite. It's something that anyone can do with the right approach and mindset. You don't need to be a rocket scientist to make money in the stock market. In fact, some of the most successful investors are those who keep things simple and stick to the basics. Forget about having a crystal ball. What you really need is a solid plan and the discipline to stick to it. A well-thought-out strategy can guide you through the ups and downs of the market, helping you make informed decisions rather than emotional ones. Emotions can wreck your portfolio faster than a bad trade. Fear and greed are powerful forces that can lead to impulsive decisions, often resulting in significant losses. Think of investing like building a house. You need a strong foundation. This foundation is built on knowledge, research, and a clear understanding of your financial goals. In investing, that foundation is a sound strategy based on proven principles. Diversification, risk management, and long-term planning are key components of a successful investment strategy. This will help you weather the inevitable storms in the market. Market volatility is a given, but with a solid plan, you can navigate through the turbulence without losing sight of your long-term objectives. Keep your cool when everyone else is panicking. Staying calm and composed allows you to make rational decisions, even when the market is in turmoil. And when others are overly optimistic, take a step back and reassess. It's important to remain objective and not get swept up in market euphoria, which can lead to overvalued investments. Remember, successful investing is a marathon, not a sprint. Patience and persistence are crucial. By focusing on long-term growth rather than short-term gains, you can build a robust portfolio that stands the test of time. The godfather of value investing, Benjamin Graham, a man whose principles have shaped the world of finance for generations. Benjamin Graham was the OG of value investing. He laid the foundation for what we now consider modern investment strategies. His book, The Intelligent Investor, is like the Bible for anyone who wants to grow their wealth over the long haul. It's a timeless guide that has educated countless investors on the importance of sound financial principles. Graham's strategy? Buy stocks when they're on sale. He believed in purchasing undervalued stocks that the market had overlooked. Sounds simple, right? That's because it is. But the simplicity of his approach is what makes it so powerful. But simple doesn't mean easy. The market is full of noise and distractions, making it challenging to stay focused on the fundamentals. It takes discipline and patience to find those undervalued gems. Graham emphasized the importance of thorough research and analysis. Graham's philosophy can be summed up in two words: margin of safety. This concept is about buying securities at a price significantly below their intrinsic value to minimize risk. We'll dive into that more later. Understanding the margin of safety is crucial for any serious investor. But for now, just know that Graham's teachings have stood the test of time. His principles have been validated through decades of market cycles. His ideas are just as relevant today as they were decades ago. In a world where markets are constantly evolving, Graham's wisdom remains a beacon for those seeking financial stability and growth. The manic Mr. Market friend or foe. Imagine a guy named Mr. Market. He shows up at your door every day trying to sell you stocks. Some days he's euphoric, offering sky-high prices. Other days, he's downright depressed, practically giving stocks away. That's the stock market in a nutshell. It's driven by emotions, fear, and greed. Mr. Market doesn't always know what he's talking about. In fact, he's often dead wrong. Your job as an intelligent investor? Ignore the noise. Don't let Mr. Market dictate your moves. Instead, take advantage of his mood swings. Buy when he's down in the dumps, and sell when he's riding high. Mastering the market mood swings. Buy low, sell high, buy low, sell high. It's the oldest rule in the book, and yet, so many investors do the exact opposite. They get caught up in the hype, buying when prices are soaring and selling when the market tanks. Don't be that investor. Remember Mr. Market, he's always trying to trick you. That's why it's crucial to have a set of investment criteria. What are you looking for in a stock? Don't just buy any stock. Look for companies with solid fundamentals, strong track records, and good management teams. And most importantly, buy them at a price that makes sense. Section 5. Playing it safe. The Defensive Investor's Handbook. Not everyone is cut out to be a high-flying, risk-taking investor. And that's okay. If you're someone who values stability and peace of mind, then you're a defensive investor at heart. Defensive investing is all about managing risk. You're not looking to get rich quick. Slow and steady wins the race. Diversification is key. Don't put all your eggs in one basket. Invest in a mix of stocks, bonds, and maybe even some real estate. Think about it like this. You're building a financial fortress to protect your wealth. Section 6. Index funds. The easy button for defensive investors. Index funds are like the autopilot of the investing world. They're a type of mutual fund that tracks a specific market index like the S&P 500. Index funds are a great option for defensive investors. Why? Because they offer instant diversification. When you buy an S&P 500 index fund, you're investing in 500 of the largest companies in the US. Plus, they're super low cost. Index funds are a set-it-and-forget-it investment. You can just sit back, relax, and let the market do its thing. Section 7. The enterprising investor seeking higher returns. Now, if you're feeling a bit more adventurous, you might be an enterprising investor. This type of investor is not content with average market returns and is willing to take on more risk in pursuit of higher gains. You're willing to put in the time and effort to potentially earn higher returns. This means dedicating hours to research, analyzing financial statements, and staying updated with market trends. But remember, higher returns usually come with higher risks. The market can be volatile and prices can fluctuate wildly, sometimes without any apparent reason. Enterprising investing requires more research, patience, and discipline. It's not just about making quick decisions, it's about making informed ones. You're not just following the herd, instead you're carving your own path, making decisions based on thorough analysis, rather than market hype. You're digging deeper, looking for hidden gems that the market has overlooked. These could be undervalued stocks, emerging industries, or small-cap companies with high growth potential. This is where Graham's concept of margin of safety really comes into play. By buying stocks at a significant discount to their intrinsic value, you create a buffer against potential losses. You want to buy stocks trading significantly below their intrinsic value. This approach not only provides a cushion, but also increases the potential for substantial gains if the market eventually recognizes the stock's true worth. That way, even if you're wrong about the company's prospects, you have a cushion to absorb potential losses. This strategy requires a keen eye for detail, a deep understanding of the market, and the patience to wait for the right opportunities. Networking with other investors and attending financial seminars can also provide valuable insights and opportunities. The more knowledge and connections you have, the better equipped you'll be to make informed decisions. In the end, the enterprising investor's journey is one of continuous learning and adaptation. With the right mindset and strategies, the potential for higher returns is within reach. Section 8. The allure and danger of growth stocks. Growth stocks are the shiny objects of the investing world. They promise rapid growth and high returns. Think tech companies, innovative startups, and the next big thing. But here's the catch: growth stocks can be incredibly risky. They often trade at high valuations, meaning investors are betting on future earnings, not current performance. And sometimes those rosy expectations don't pan out. That's why it's crucial to be selective when investing in growth stocks. Don't get caught up in the hype. Do your homework and make sure the company has a solid plan for sustainable growth. Section 9. The margin of safety, your financial cushion. Imagine you're buying a used car. You wouldn't just pay the sticker price without checking under the hood, right? You want to make sure you're getting a good deal, with room for potential repairs. The margin of safety is like that under the hood check for stocks. It's the difference between a stock's price and its intrinsic value. The bigger the margin, the safer your investment. Graham believed that buying stocks with a margin of safety reduced risk. If the company stumbles, that margin acts as a buffer, protecting your investment. Section 10. Debunking the myth risk versus reward. Many people think high risk equals high reward in investing. But Graham argued that's not always the case. In fact, sometimes the riskiest investments offer the lowest returns. Why? Because investors often overpay for the potential upside, driving prices to unsustainable levels. Remember, risk is not your friend. Your goal as an investor is to manage and minimize risk, not chase after it. Focus on buying quality companies at reasonable prices, and you'll be well on your way to achieving your financial goals. Section 11. Timeless wisdom, Graham's enduring legacy. Benjamin Graham's The Intelligent Investor isn't just a book, it's a roadmap to financial success. His principles of value investing, margin of safety, and emotional discipline are as relevant today as they were decades ago. The market may change, but human nature doesn't. Investors will always be susceptible to fear and greed. That's why Graham's teachings are so powerful. They provide a framework for making rational decisions, even in the face of market turmoil. So, if you're looking to build lasting wealth, do yourself a favor. Pick up a copy of The Intelligent Investor and start putting